Hello everyone, and welcome. I'm excited to be here today to introduce our presentation. Today's session is titled Giants of After School YouTube Lesson. We'll be focusing on Grade 12 accounting for Term 1 according to CAPS. Over the course of this presentation, we'll explore key concepts and important topics to help you succeed in your accounting studies. Let's get started. Let's take a moment to explore some key concepts and principles that underpin our financial management framework. First up is ethics and internal control, which are fundamental to ensuring integrity and accountability in all our processes. Upholding strong ethical standards helps us maintain trust and transparency, while effective internal controls safeguard our assets and prevent errors or fraud. Next, we have fixed assets. These are long-term resources like equipment or property that support our operations over time. Managing them properly is crucial for accurate financial reporting and planning. Then, there's inventory, which involves all the goods and materials we hold for sale or use. Proper inventory management helps us optimize stock levels and reduce costs. We also need to pay attention to VAT, or value-added tax. Understanding how VAT works is essential for compliance and accurate tax reporting. It impacts our pricing, invoicing, and overall financial health. Finally, we'll touch on the CAPS overview, which provides a broader perspective on our overall control environment and how these concepts connect to ensure sound financial practices. All these elements come together to create a cohesive system that supports our organization's integrity, efficiency, and compliance. Let's take a closer look at some fundamental accounting concepts today, starting with assets. Assets are everything a business owns that has value, like cash, inventory, or equipment. They are essential because they represent the resources a company uses to operate and grow. Understanding assets helps us see the company's overall worth. Next, we have liabilities. These are the obligations or debts that a business owes to others, such as loans, accounts payable, or mortgages. Knowing liabilities is crucial because they show what the company needs to settle in the future, affecting its financial health. Moving on to equity, which essentially is the owner's claim on the assets after subtracting liabilities. Think of it as the net worth of the business, the residual interest that belongs to the owners. Then there are income and expenses. Income is the money earned from business activities, like sales or services provided. Expenses are the costs incurred in earning that income, such as rent, salaries, or utilities. The difference between income and expenses determines whether the company is profitable. Finally, let's touch on some key accounting concepts that tie all these elements together. These principles guide how we record and report financial information, ensuring consistency and accuracy across reporting periods. By understanding these core concepts, assets, liabilities, equity, income, and expenses, and the underlying accounting principles, we build a solid foundation for analyzing and interpreting financial statements. This understanding is vital as we move forward in mastering the broader topics of financial accounting. Let's take a closer look at some fundamental accounting concepts that guide how we prepare and interpret financial statements. First up is historical cost. This means that assets are recorded based on the original price paid at the time of acquisition, which provides objectivity and reliability. However, it's important to remember that this can sometimes mean the recorded value isn't reflective of current market conditions. Next, we have matching. This principle emphasizes that expenses should be recognized in the same period as the revenues they help generate. It's all about ensuring that our financial statements accurately reflect the true profitability of a business during a specific time frame. Then there's prudence. This encourages us to be cautious in our estimations and not to overstate assets or income. It acts as a safeguard to prevent overly optimistic financial reporting, helping maintain trust and integrity. Moving on to going concern. This assumes that a business will continue to operate into the foreseeable future, which affects how assets and liabilities are valued. It's a foundational concept because if a company isn't considered a going concern, the accounting approach would need to change significantly. Finally, all these points are grounded in core accounting principles that aim to ensure consistency, comparability, and transparency in financial reporting. When we understand these principles, we get a clearer picture of how financial information is prepared and why it's reliable for decision-making. Connecting all these ideas, they form the backbone of sound accounting practice, helping us maintain trust and accuracy in our financial communications. Let's talk about some core principles that are vital in accounting: honesty and transparency. These might seem straightforward, but they are the foundation of trust in financial reporting. When we're honest, we're committed to presenting accurate and truthful information, which builds credibility with stakeholders. Transparency goes a step further. It's about being open and clear about how financial data is generated and reported, so everyone can understand and rely on it. Now, even with these principles in place, there are always risks involved, particularly fraud risks. These are the potential threats that someone might manipulate or falsify financial information for personal gain. Recognizing these risks is crucial because it helps us implement controls to prevent misconduct. This naturally leads us into the importance of ethics in accounting. Ethical behavior isn't just about following rules, it's about doing what's right, even when no one is watching. Upholding strong ethics ensures that our profession maintains its integrity and public trust. All of these points tie back into our overall theme of responsible financial management. By emphasizing honesty, transparency, understanding fraud risks, and committing to ethical standards, we reinforce the reliability and credibility of financial information. It's about fostering a culture where integrity guides every decision and action. Let's take a closer look at some key internal control measures that are essential for maintaining a secure and efficient operation. First, we have the separation of duties. This is about ensuring that no single person has control over all aspects of a financial transaction. By splitting responsibilities, we reduce the risk of errors or fraud slipping through unnoticed. Next, there's authorization. This means that important transactions or decisions should always be approved by someone with the proper authority. It acts as a checkpoint to prevent unauthorized activities and helps maintain accountability. Then we have stock control. This involves keeping a close eye on inventory levels, movements, and discrepancies. Proper stock control helps prevent theft, loss, or overstocking, which can be costly for the organization. Finally, internal control as a whole encompasses these practices and more. It's about creating a system that ensures accuracy, safeguards assets, and promotes operational efficiency. When these elements work together, they strengthen the overall integrity of our financial and operational processes, which is vital to the overall health and success of the organization. Now, let's take a closer look at the different types of assets that are essential to our operations. First, we have vehicles. These are critical for transportation, logistics, and ensuring our services reach where they need to go. Next, equipment. This includes all the tools and machinery necessary to carry out our daily tasks efficiently and effectively. Then, we have buildings. These are our physical spaces, offices, warehouses, manufacturing plants, that form the backbone of our infrastructure. Moving on, fixed assets encompass all of these tangible items: vehicles, equipment, buildings, that provide long-term value to our organization. Recognizing and managing these assets properly is vital because they support our overall strategy and help us deliver value to our stakeholders. So, understanding how each of these components fits into our asset management framework is key to maintaining our operational strength and ensuring sustainable growth. Let's take a closer look at depreciation methods, starting with the straight-line approach. This method is quite straightforward. Expenses are spread evenly over the asset's useful life, which makes it simple to calculate and easy to understand. It's often preferred for its predictability, giving a consistent expense each period. Next, we have the diminishing balance method. This approach accelerates depreciation, meaning larger expenses are recorded in the earlier years of an asset's life. It's useful when an asset is more productive or loses value faster in its initial years, and it aligns better with how some assets actually depreciate. Both of these methods are essential because they help us match expenses with revenues more accurately, which is key to understanding an asset's true value over time. By choosing the appropriate method, we ensure our financial statements reflect a realistic picture of our assets' depreciation, supporting better decision-making and financial planning. Let's take a closer look at inventory systems, specifically the periodic and perpetual methods. The periodic inventory system is one where we update our inventory records at specific intervals, like monthly or quarterly. This means we don't track every single sale or purchase in real time, but rather do a thorough count at the end of each period to determine our inventory levels and cost of goods sold. On the other hand, the perpetual inventory system continuously updates inventory records whenever a sale or purchase occurs. This approach gives us real-time data, which is especially useful for managing stock levels more accurately and making quicker business decisions. Both systems have their advantages and are suited to different types of businesses. The key takeaway here is understanding which system aligns best with your operational needs and overall strategy, as this impacts how you track, manage, and report inventory. This choice ultimately ties into our broader goal of maintaining accurate financial records and ensuring efficient inventory management. Let's take a closer look at some common inventory valuation methods. First, we have FIFO, which stands for first in, first out. This method assumes that the oldest inventory items are sold first, so the remaining inventory consists of the most recent purchases. It's a straightforward approach and often aligns well with the actual flow of goods in many industries. Next is the weighted average method. Here, instead of tracking individual costs, we calculate an average cost for all inventory items available during the period. This smooths out price fluctuations and provides a consistent valuation, especially useful when prices are changing frequently. Then we have the lower of cost or net realizable value, or NRV. This is more of a conservative approach where we compare the cost of inventory with the estimated selling price minus any costs to sell. We record inventory at the lower of these two values to ensure our financial statements don't overstate assets. All of these methods are crucial because they impact how we report inventory on our financial statements. Choosing the right one depends on the nature of the business and the economic environment. Understanding these valuation techniques helps us ensure accuracy and compliance in our financial reporting. Let's take a closer look at VAT, which is set at a rate of 15%. When we talk about input VAT, we're referring to the tax that a business pays on its purchases. Conversely, output VAT is the tax that a business collects from its customers when selling goods or services. The difference between these two, which we simply call VAT, determines whether a business owes money to the tax authorities or can claim a refund. Understanding how input and output VAT work together is crucial for managing cash flow and ensuring compliance with tax regulations. This relationship highlights the importance of accurate record-keeping and timely reporting. Remember, the overall goal is to ensure that the VAT paid on purchases is properly offset against the VAT collected from sales, so businesses only pay the net amount due. This is a fundamental aspect of VAT that ties directly into the overall tax system and our financial management practices. All right, let's delve into what this slide covers: concepts, calculations, ethics questions, and exam practice. First off, when we talk about concepts, we're really focusing on the foundational ideas that underpin everything else. These are the key principles you need to grasp thoroughly to succeed. Then, moving on to calculations, this is where the practical application comes in, solving problems, applying formulas, and ensuring you're comfortable with the numbers. Next, ethics questions are crucial. They challenge you to think critically about real-world implications and moral considerations, which are often part of the exam. Finally, exam practice ties it all together. It's about applying what you've learned in a timed environment to build confidence. Remember, these areas are interconnected. Solid understanding of concepts makes calculations easier, ethics questions deepen your critical thinking, and consistent practice prepares you for the actual exam. So, focus on mastering each part, and you'll be well on your way to success. Subscribe, like, share. Join Giants of After School. If you found this content helpful, please subscribe to stay updated with all our latest insights. Don't forget to like the video if you enjoyed it, and share it with others who might benefit. Joining Giants of After School means becoming part of a community dedicated to growth, learning, and support outside of regular school hours. It's about building connections, expanding your knowledge, and becoming a part of something bigger. So I encourage you to take that step, subscribe, and join us on this exciting journey. Thank you for being here.